Imagine being in Adam's shoes, falling in love with a home listed at $750,000, making an offer and getting pre-approved for an FHA mortgage. It's the perfect home, the one he's been dreaming of. But here's the catch. Following inspections and appraisals, the home is valued at only $715,000. That's a $35,000 gap that Adam's FHA mortgage won't cover. Why is this? FHA loans have stringent guidelines on the maximum loan-to-value ratio they accept. The property must appraise for the purchase price or higher, and in Adam's case, it falls short. So Adam is left scratching his head, wondering how he can secure his dream home without the additional $35,000. The question then becomes, how can Adam navigate this tricky situation and bridge the gap between his offer and the appraised value? So, what can Adam do to bridge this gap and secure his dream home? Enter the piggyback mortgage, a potential solution to Adam's problem. A piggyback mortgage, also known as an October 10th 80 loan, involves taking out two separate loans simultaneously to cover the purchase price and dodge private mortgage insurance or PMI. So how could this work for Adam? Let's break it down. Firstly, Adam could obtain a first mortgage for 80% of the purchase price. That would equate to $600,000, which is 80% of the $750,000 asking price. This first mortgage becomes the substantial chunk of the financing. Next comes the second mortgage. In Adam's case, this would cover 10% of the purchase price. That's another $75,000, making up 10% of the $750,000 total. This second mortgage fills the gap and allows Adam to reach the full purchase price of the home. Lastly, Adam would make a down payment of 10%, which aligns with the second mortgage amount. That's another $75,000, rounding out the full $750,000. But wait, there's more to this piggyback mortgage than just the numbers. By putting down 10% and taking out a second mortgage for another 10%, Adam can sidestep private mortgage insurance. This is a significant advantage, as PMI is typically required for conventional loans with less than a 20% down payment. Moreover, this second mortgage in the piggyback structure helps Adam cover the $35,000 difference between the appraised value and the purchase price. It's like a bridge, allowing the transaction to move forward even when the home appraisal falls short. However, it's important to note that Adam would need to qualify for both the first and second mortgages. Lenders will assess his income, credit score, and other factors to ensure he can repay both loans. And of course, he should carefully scrutinize the terms and interest rates of both loans to ensure they fit within his long-term budget. It seems like a neat solution, doesn't it? But let's delve deeper. The piggyback mortgage has its advantages, but it also warrants careful consideration. One of the primary advantages of a piggyback mortgage is the ability to avoid private mortgage insurance, or PMI. Typically, PMI is required for conventional loans with less than a 20% down payment. However, in Adam's case, by putting down 10% and taking out a second mortgage for another 10%, he neatly sidesteps this requirement. This could result in substantial savings over the life of his loan. Another key advantage is the ability to cover the appraisal gap. This is the $35,000 difference between the appraised value of the home and the purchase price. By using a piggyback mortgage, Adam can bridge this gap and move forward with the purchase, even though his FHA loan won't cover the entire amount. However, it's important to remember that a piggyback mortgage involves taking out two separate loans. This means that Adam will need to qualify for both the first and second mortgages. The lenders will assess his income, credit score, and other factors to ensure that he has the ability to repay both loans. This could potentially be a more complex and rigorous approval process than with a single loan. Finally, there are key financial considerations that Adam needs to take into account. He should carefully evaluate the terms and interest rates associated with both loans. It's crucial that these are manageable within his budget over the long term. He should also consider the overall cost of the two loans compared to other financing options. In essence, a piggyback mortgage could be a viable solution for Adam, but it's crucial for him to consult with a lender to explore all options and choose the best path forward. Remember, every financial situation is unique, and while a piggyback mortgage might be a good fit for Adam, it's important to thoroughly examine all available options and choose the one that best suits individual circumstances and goals.